The 360 on Energy and Carbon, hosted by 360 Energy. Following a successful career on the New York Mercantile Exchange, Stephen Schork transitioned to an upstairs trading operation. He quickly realized that the demise of open outcry on the commodity futures exchanges eliminated the transparency of deal flow. In response to this void, Stephen developed proprietary multivariate probabilistic models to identify statistically significant ranges at which to trade energy products and/or hedge exposure. In 2005, Stephen co-founded the Schork Group, the industry's premier provider of price range forecasting and independent fundamental, quantitative, and technical analysis. Central to the company's product suite is the Schork Volatility Bands, SVB. Professionals in the global energy arena rely upon this methodology to improve economic performance and manage risk. Stephen is a registered commodity trading advisor with the National Futures Association. Now let's get into the episode with Stephen, principal and editor at the Schork Group. Welcome back, Dave, John, and Stephen.
It's great to be back. Thank you.
And I'm terribly excited about this. This is fantastic timing to have Stephen online with us, especially with the volatility and the elevated energy prices. So it's just great timing.
Yeah, it is fantastic because it's something that everybody, particularly those people with no knowledge about it, are talking about. So to get somebody with knowledge talking about it has got to be good.
Yeah, there certainly isn't a deficit of things to talk about in the energy markets nowadays.
No.
Well, on that note, what changes have we seen in the past year in energy markets, Stephen?
The biggest change, outside of the obvious ones, which I'll go into, is the acknowledgement here in the United States that one, inflation is not transitory, and two, the runaway inflation that we're seeing, in the opinion of the Schork Group, has led us into, at this point, a mild recession. So, of course, with a downturn in economic demand, that will certainly weigh on energy prices. So because the powers that be avoided the concept of inflation, and I want to be clear, it's not just inflation on the energy sector, but it is also just as important, the inflation we're seeing on the food sector. And that is a direct correlation of the war, shall we say, that has been initiated by this White House and promoted by the ESG crowd on Wall Street to take the fight to natural gas. What most people cannot appreciate is natural gas is the primary feedstock to ammonium nitrate, i.e. fertilizer. So we've had a couple of events over the last 2 years in the natural gas market that has directly impacted the price of fertilizer. The first move was made 2 years ago by the EU. The EU was unhappy that the fact that carbon permits, the allowances for fossil fuel burners to trade and to create energy, the price of these permits were too low. Therefore, you weren't getting the impetus that the EU wanted to switch out of fossil fuel consumption. So the plan was to, one, cut the supply of permits. Now, of course, economics 101 means that when you cut the supply, your price will generally go up. And certainly that's what we saw with permits. Now, the EU had it half right. They maneuvered and manipulated the price of carbon higher. Their goal was to push consumption out of coal and into renewables. Unfortunately, renewables are simply not capable, not ready at this juncture to pick up the increased demand. So instead of going into renewables, European consumers went into the natural gas market. And this is what has happened is that we've seen over the past 2 years in 1,700%. I'm going to repeat that number, 1,700% increase in the price of natural gas over the past 2 years in Europe. At one point, a couple of weeks ago, European natural gas was trading almost the equivalent of $600 barrel oil. It got as high as $570, $8 natural gas, the equivalent of that price in oil. So clearly this has led certainly to weigh on the natural gas and the consumption and therefore the economic prospects for manufacturers in Europe. Now, of course, the situation in Ukraine, which occurred 1 year after this manipulation, has only compounded that situation. Of course, here in the United States now, which is the global swing producer of natural gas, we've had a couple of instances, once again, going back to fertilizer, both in Europe, which once again, the food situation, supply insecurity has been compounded again with the lack of exports coming out of Ukraine. What happened here in the United States is twofold in the food inflation. One, again, the exorbitant price we've seen spike in natural gas, and that is translated into fertilizer prices. So farmers back in the spring put or planted less corn. Corn yields this year are going to be at better than 5-year lows. Why is that? Because corn production requires a tremendous amount of fertilizer. Soybean production does not. So farmers opted to put more soybeans into the ground than corn. And then the lack of corn situation was compounded by the maneuvers in Washington to increase the consumption of corn via the energy markets. We lowered or we put a bit rescinded the amount of ethanol, i.e., corn, that can go into our gas tanks. So we artificially created demand for corn at a time when corn plantings were at better than a 5-year low. We've had difficult weather in the Corn Belt. So we are now starting the harvest, and we're already expecting a very low yield on this year's harvest. And executives in the food industry are now telling us that we're going to need to see two bumper crops of corn to compensate for what we've seen this summer in the U.S. Corn Belt and what we're currently are continuing to see in Ukraine. So right now, even though energy prices have come off since their summer highs, the other shoe that is on the consumer neck is the rapid rise in food costs. In fact, we're now seeing the 6 major categories tracked by the Bureau of Labor Statistics, which publishes the inflation numbers. We're looking at more than half of those categories that are at all-time highs. So as we go forward, because we ignored all of this, the powers that be played whack-a-mole. They were panicked politically by the rise in energy costs at the start of the spring and, at the start of summer, and they took measures to address that. Measures that will ultimately, down the long road, increase or maintain high energy costs. And they ignored the food situation. So now that we do have inflation that is not going away, Jay Powell at the Federal Reserve has no choice but to pull a Paul Volcker, the chairman of the Federal Reserve in the early 1980s. He has to tank the U.S. economy to tame this inflation. And that can only be because they were late to the table, will have a deleterious impact on the energy crisis. Now that, to go and to continue to answer the change of the past year, what does that mean? It means the dollar now is raging as we manipulate interest costs. So as we know in trading just the other day, the English pound sterling dipped to a below the dollar. That's never happened before. We know the dollar relative to the euro is trading at 20-year highs. The dollar is very strong. Now, what does this mean? It means economies that consume energy, oil, i.e., Europe, for instance, that cost, because energy prices are priced in US dollars, and the fact that the dollar is at a 20-year high, that makes the energy situation in Europe that much worse, because not only is the supply situation tenuous, the supply situation coming from other sources, imports from the LNG market, for instance, are at, relative to the dollar, exorbitant levels. So those are the two macroeconomic impacts that have really changed the year. And then obviously the elephant in the room, of course, is Russia's invasion of Ukraine, which does not seem, with what we just saw the other day with the sabotage of 2 underwater explosions that have effectively forever taking Nord Stream supply of Russian gas via pipeline into Germany. Germany and Europe will never see a molecule of gas ever coming again from Russia via the Nord Stream pipeline. So we certainly have that situation, which is only getting worse, of course, with Russia's decision to annex what little ground it controls in Ukraine. And what that means, it is an ongoing threat. Geopolitically, of course, we're actually, or not we, I'll call him that madman in Moscow, is saber rattling, not with conventional weapons, but with nuclear weapons. So that geopolitical risk will continue to get priced into the energy sector and therefore maintain volatility, which is at an all-time high. So those are essentially my two key points, that the biggest changes over the past 2 years, inflation and what that means for the dollar, what that means for consumption and how it's contributing to an economic downturn, and of course, the volatility associated with Ukraine.
So, Stephen, I'm so glad because Stephen was on Bloomberg early yesterday morning, which I was watching, and he had alluded to this, but you went into really great detail here and explained it. So thank you for that. And the other thing that John and I were talking about, because I had mentioned to John about your discussion, is that it just shows how much energy has an impact to the rest of society and how it has a multiple impact. You're describing how it impacts food now. So, it's certainly a very important topic. The next question, and you've initiated this before, but I'll ask you specifically, how will the Ukraine-Russia war impact not only natural gas prices, because I think you'll certainly want to talk about that, but I'm really interested in how it's going to impact the industry this winter or down the road. So I wonder if you could share with us your thoughts.
Yes, very well. So down the road, it is a bullish industry to be in. And if we can go back over the past 20 years, we've seen the full cycle play out in the global energy market. Coming out of the 1990s, demand for energy was relatively muted, and this was for a number of factors. Through the 1990s, thanks in part or greatly because of the dot-com boom and the productivity gains made of greater use, we saw the U.S. economy absolutely take off after that early recession, which occurred right after the Saddam Hussein's invasion of Kuwait. So for the better part of the 90s, the United States economy was the dominant economy in the world, which was again compounded by the fall of communism in the Soviet Union. And while that was a boom for the US economy, it was a drag on the European economy, of course, because Europe now had to integrate and figure out how to incorporate newly freed Eastern European countries into their economy. And of course, those economies, after 70 years of communism, were completely decimated. So as Europe incorporated these economies on this new demand, it took that decade for that to weed its way through. By 2000, the Europeans had it incorporated, and we started to see not only strong demand coming after the dot-com recession in the early 2000s, we not only saw a strong rebound in US demand, but now this was compounded by a resurgence in demand out of Europe. And we also saw a surge in demand out of China now, and that was a big driver. Now, this caused a massive rally in the energy complex because during the 80s and the 90s, we did not invest in oil and gas because there was no return on investing in oil and gas when oil prices averaged below $20 a barrel for the better part of the 80s and 90s. So in the early 2000s, this false narrative was created that the world was running out of gas, the world was running out of oil. Now, of course, this was fallacy. We weren't running out of oil. The earth is still chock-a-block with fossil fuels that can be mined and sourced. What we weren't doing, and the reason why we had this perception, is because we just spent 2 decades, a generation, not looking for it. So because we weren't looking for it, we weren't prepared, both from an equipment standpoint and a manpower standpoint. So what happens in economics is high prices are the best cure for high prices. And we drove oil prices, which at one point in 1999 were below $10 a barrel. And by 2008, they were pushing up $150 a barrel. And this led to a boom in investment, great opportunities. Manpower came back in. It made the economics on shale, which we always knew the shale oil gas was in North America. We always knew on the Saskatchewan plain coming down from Canada into the Dakotas in the United States, we always knew there was more oil trapped in those rocks than there was on the entire Saudi Arabian peninsula. But because of the economics, we couldn't extract it. Well, you drive oil from $9 a barrel to $150 a barrel, all of a sudden the economics improve, and we had a flood of oil coming into the market at a time when the global economy was entering the Great Recession. So we spent the first 10 years driving oil and natural gas prices to unprecedented levels. We then took an unprecedented amount of oil and gas out of the ground at a time when economic demand dried up. So as the economy began to rebound, and it was a soft rebound given the severity of the Great Recession, we couldn't compensate for all of this fossil fuels, oil and natural gas coming to the market. So we went in from a 10-year bull market in oil and gas to a 10-year bear market in oil and natural gas. So by 2020, we've now figured it out. We've built enough infrastructure to get oil and gas from where it's being produced to where it is being consumed. To the point where 5 years ago, when we were still in this bear market in natural gas, there was concern in the US natural gas export market, the LNG market, that all of this capacity to export gas to Asia and Europe, there was too much of it because natural gas prices were so depressed. And they were so depressed, this led to a sharp decline in alternative BTUs, fossil fuels. That is to say, we had a significant drop in coal output or coal consumption. The same with nuclear. Natural gas prices were so low that nuclear generation, because of the tremendous amount of upkeep and investment that requires, couldn't compete with natural gas. So we had a lot of retirements, both in coal plants and nuclear plants. When natural gas prices were below $3 a decatherm, that was a good thing. But once again, economics work. You take out your alternatives of nukes and coal, you put more of your eggs into the natural gas market, and once we have a rebound in natural gas, you have a market that is stuck because they don't have these alternatives to fall back on. So what has happened now in the market is the natural gas has had a whole seismic shift. The natural gas market, whether it's in North America or in Europe, is a regional market because you can only economically transport it from your producing area. You put it on a specific pipeline that only goes to one consumption area. And therefore, that consumption, that pipeline from producer to consumption, that's your market margin on the myriad of pipelines around the world. Now, with the advent of higher natural gas prices, this made LNG more of an attractive option because we simply don't, or Asia simply doesn't have enough access. And as we've learned with Ukraine, the Europeans have put too much of their reliance on one source, and that is Russia. So now natural gas is trading here in the United States and around the world like an oil market, where geopolitical events now impact the price of natural gas. And this has led to a change in how producers around the world react. It never used to be that an event, geopolitical event 5,000 miles away, would impact the price of natural gas in Louisiana in the United States. Now that has changed. Russia has brought that to the forefront. So what has happened now is where 5 years investment in LNG offtake and export capacity from the United States and investment in import capacity to Europe and in Asia has increased. And the Ukraine situation has really brought that to the forefront. So from a long-term industry standpoint, natural gas is, now there's still that war on natural gas, but that is the fossil fuel of the future. That is that bridge fuel that in perhaps 2, 3 generations will get us to a reliable source of renewable energy. But for the next 3 generations, it is investment in natural gas, the production, the transport, and the consumption of.
Thank you for that, Steve.
Okay, Stephen, you touched on events in Europe with Nord Stream, and it's very interesting reading the press on that because, nobody's actually saying it definitely was sabotage, but most observers think it was. I think, what was it? 3 explosions on the same pipeline, seismic measurements of them and everything else. But the question I've got for you is, do we have enough storage for natural gas in Europe to get us through winter? And if we do, what sort of impact is Europe filling its storage going to have on North America?
Well, ultimately, again, that is going to be a bullish question. To answer the first question, European storage levels at this point ahead of winter are ahead of where they were last year. That's a good thing. Natural gas prices are also incredibly more expensive today than last year. And that, of course, will impact demand. What's good about natural gas during the winter, as opposed to the summer consumption for air conditioning demand, is I could always put a sweater on or another jacket on to stay warm and cut my consumption. And this is what Europeans are going to have to do with regard to natural gas prices. Now, even though we're at those 5-year highs, there is concern, legitimate concern, that by the end of the winter, typically late March, early April, gas storage will be effectively at zero pressure, therefore, i.e., empty. And certainly that is having more of a long term impact. What is also currently happening with natural gas prices, and part of why they're so high, is we had an incident at the beginning of the summer at a major LNG export facility in the Gulf Coast. That facility was responsible for about 1/5 of US exports. Of course, those exports, the majority of which were headed to Europe. Because of this incident, that export facility has been unable to bring production back up in export gas. So US exports of natural gas have been lower than what they were projected to be at the beginning of the summer because we cannot export this gas. This facility, by all indications, will not come online again until the first quarter. So effectively, when the Europeans will have to go through a winter with 1/5 fewer molecules being imported from the United States than what they were planning on at the end of last winter. So this is having an outsized effect on European gas prices, as is it's having a negative impact on US prices, because if 1/5 of your exports bottled up, that is 1/5 of more gas that can be counted on to satiate domestic here in the United States demand. But once that export facility gets back and running, probably by the first quarter, that bodes well because, as we said, or as I said, that by the end of next winter, a European gas storage will be effectively empty, but you'll have this excess gas coming from the United States from this export facility that was shut in. So that will have an impact on the arbitrage, where right now European gas prices are high in part because the lack of gas coming from this export facility, but that will reverse. And once that export facility comes back online, that will be more bullish for US prices next spring as we begin our refill season. And it will help tamp down natural gas prices in Europe.
Thank you for that. I think what it goes to underscore is how energy has become a global issue. It's no longer a local issue, is it?
Yeah, absolutely. And to bring that home is we start these crusades against fossil fuels. And look, I'm all for renewables. I drive an electric hybrid car. I love it. I love it in part, not because I think I'm doing something good for the environment. I'm not doing something. Anyone who drives are living this false dream that you're doing something good for the economy. When we look at what the heavy metals that go into a solar panel or the metal that goes into a windmill blade, we're having a significant problem around the globe that I'll give you a for instance. In California, they went whole hog 20 years ago, encouraging consumers to install solar panels on their homes. And that worked great. But those solar panels are done through their useful life and they have to be replaced. Well, California never had a plan to dispose of these panels, and they're building up in landfills. And your risk now is the heavy metals trapped in those panels will begin to seep into the soil and, of course, risk your water supply. It's the same thing with windmill blades. That early generation of windmill blades have been replaced. They cannot be recycled. They are filling up hills. So when we talk about one, the amount of rare earth metals that has to go into a battery, the amount of earth we have to rip up will make 130 years of coal and oil mining look like a literal drop in the bucket. So we are setting ourselves, the globe that is, on a path to rip apart the earth to get to these metals for something we think we're doing. So renewables, battery technology is not there yet, but we are mandating that we go there. The electrical grids cannot handle this increased load, and the environment cannot handle the degradation that we're going to see because of this mining. I like my electric hybrid, as I said, because I know I'm not doing something good for the economy, and perhaps I'm doing something bad for the economy. What I like about it is here in the United States, for the moment, electricity to charge my car, my part of the battery in my car is far below the price of gasoline. So my gasoline consumption has dropped literally 75%. So I'm more inoculated to the price of gasoline for the time being. But I know what most electric car drivers in the United States don't know is that is going to be short lived. Because as we're seeing as an example in Europe, because of the situation, because of the war on fossil fuels, electricity costs are skyrocketing because European renewable infrastructure cannot compensate for all this increased demand. So now electricity prices to charge your car at these rapid charging stations is on par with gasoline prices in Europe. And that's pretty mind boggling because gasoline prices in Europe are so heavily taxed. If you take the taxes out of European gasoline prices, electricity to charge your car in Europe is uneconomical. It's going to be the same situation here in the United States, whereas the Europeans are paying the equivalent of $72 for a kilowatt hour to charge the battery. Here in the United States, I'm paying less than 9 cents a kilowatt hour. But that, of course, will go up as our reliance on renewables, unreliable renewables, increase. The other shoe that will drop in the years ahead for electricity or EV drivers is taxes. Right now, the US government takes a significant amount of tax out of the price. Nearly 51 cents on every gallon sold of gasoline in the United States goes to the government to maintain the road system. EV drivers don't have to do that. So EV drivers are driving on roads, they're freeloading off of gasoline drivers. Now, of course, that situation will have to change. And once the United States begins to tax EV drivers to maintain the roads, compounded by higher power prices, which are certainly coming, the economics are going to change on EV drivers as well. So, what we lack around the world is a balanced approach to energy consumption. We have right now a zero sum. They even call it net zero for carbon emissions. It's a zero sum game where I have to, for every renewable molecule or electron I put onto the market, I have to decimate a fossil fuel like electron. So I'm trading my energy security for Mother Nature. And Mother Nature, simply, as we all know, is not a reliable lady. So our energy insecurity will continue to grow rather than adopting and assessing that, yes, fossil fuels in certain markets make sense. Wind power, most of the time in the UK, most of the time in West Texas, makes sense when the wind is blowing. But part of the reason why electricity prices are so high early on this year in the UK is because the wind stopped blowing and power prices went out of whack. Same situation here in the United States. Solar panels work great as long as they're useful and you're not filling up landfills with them, work great in Southern California. Don't work so great up in Detroit. So you need more fossil fuel consumptions in very regional markets. And if we had that balanced approach, and don't even get me started, or I'll start it myself. Nuclear generation, of course, is the best for the environment. It emits zero emissions, but of course that has its own bogeyman going forward. So what is happening now is we're trading this energy security. We think we're on a road to freedom, to a better economy, but we're on a road to perdition. So we're trading our vulnerability, not just from a geopolitical standpoint, but from an economic standpoint. There is a reason why Western Europe, the Scandinavian countries, the United States, Canada are the cleanest environments in the world. It's because these economies are the richest economies. If you want to see where the environment is really taking a hit, go to China, go to South America, go to Mexico, go to the stands in the Near East. These are the environments that are extremely dirty. Coincidentally, I should say, is that they're also the poorest nations around the world. The United States, Europe are heading down that path as we eat in to our economic wealth. Our ability to invest, our ability to consume renewables at higher prices goes down. And as we're seeing once again in Europe, our reliance on more abundant supplies, i.e., coal, grows. So ultimately, we're setting ourselves up, the environment for a poorer environment, and the economy for a poorer economy going forward.
David, that was a lot to like a lot. And by the way, I love the discussion and the words going, because we're going to revisit this with you as we go forward, because I think there's a lot of layers here.
To continue this episode, tune in next week for part 2.
That's all for today's episode of the 360 on Energy and Carbon podcast. Thanks for listening. Make sure to check us out on our website at 360energy.net and follow us on LinkedIn at 360energy Inc. Tune in to our podcast on Apple Music, Spotify, Anchor, or other listening platforms by searching the 360 on Energy and Carbon. You can watch the video recording and subscribe on YouTube at 360 Energy Inc. Email us your feedback at podcast@360energy.net or comment on our LinkedIn posts. See you next week.